short-term thinking. Most market participants are focused on the next quarter's earnings, the next news cycle. They fail to grasp a company's long-term potential or resilience.
Which brings us back to Graham's Mr. Market analogy, that irrational salesman.
He is. Graham literally described the market as an insane salesman who one day might offer you a Ferrari for $100 and the next a broken Chevy for $10,000. The market rarely prices companies accurately based on intrinsic value, especially in the short term.
And Buffett built his career on this idea.
Absolutely. Value investors like Buffett actively look for companies hit by bad news, because the media and the market's reaction can often exaggerate the true long-term effect on the company's underlying business fundamentals.
That's such a counterintuitive approach, like that American Express story. I remember hearing about that.
Exactly. Back in 1963, American Express stock plummeted because of a scandal involving faulty warehouse receipts for salad oil from a subsidiary. Total mess.
Salad oil, seriously?
Salad oil. But Buffett looked past the headlines. He saw that the core credit card business, the part that really mattered, was fundamentally sound and completely unaffected by this weird scandal. So while everyone else was panicking, he bought more stock, made an absolute fortune when investors eventually forgot the scandal and the true value reemerged.
Incredible, just seeing through the noise.
That's the essence of it. He also famously seeks out unpopular stocks. The stock market is often a popularity contest, right? Driven by hype. Buffett looks for valuable companies that Mr. Market just doesn't like, companies that aren't sexy or fashionable, but still consistently make money. Think about Walmart.
Right. Walmart may be overlooked by some wealthier investors chasing tech, but it remains the world's largest retailer with massive, massive revenue.
Exactly. It really emphasizes spending more time digging through dull financial reports than getting caught up in the excitement of financial media.
Okay, so how do you actually go about identifying these potentially undervalued stocks? Where do you start?
Well, a general approach is to look for strong brands, profitable companies whose stock happens to fall significantly, say 10% or more, especially if technical analysis shows good support and resistance charts, suggesting the race might be bottoming out.
Could you explain support and resistance charts just briefly? It sounds a bit technical.
Yeah, sure. In very simple terms, support is a price level where a falling stock tends to stop falling, almost like it hits a floor because buyers step in. Resistance is the opposite a level, where a rising stock tends to stop rising like it hits a ceiling because sellers take profits. It's part of technical analysis that some investors use to gauge market sentiment.
Okay.
You can also use brokerage screeners. Most online brokers have tools where you can filter stocks based on certain criteria. For example, you could input a price to earnings or PE ratio lower than, say, 15